Hey, good afternoon, traders. Well, actually, I suppose good evening. This is Trader Tim from EminiMind, and we're doing a Monday market analysis video. But the main part of this video, I wanted to talk about how I structure and enter hedge positions in the form of buying puts when the market is doing really strongly as a way to hedge my long-term position. And I do this rather than trying to sell the top and rebuy at the bottom because I just can't pick the tops and the bottoms. So rather than risk missing out on getting it slightly wrong and having the market jump 10 points and me not being a part of it, I find that I can do a lot better by keeping those long positions on and just hedging them with buying puts. But before we get into that, let's just take a quick look at the ES here. You can see we're coming up to this down or this upward trend line, the underside of the upward trend line here, and the 61.8 has broke of the short. Now, on the long side, you might say, well, the 61.8 of the long broke as well. But on the daily chart, I really like to see a close below the 61.8 in this case because it's long. Anytime we just pierce it intraday and then rally, that's not as strong of a market sentiment. And anytime we have a pullback like this and we get a close that's near the open, especially when it's at a 50%, and then we gap up the next day, that is one that you want to buy the open. Any gap up at lows is buyable, and just put a stop below the low of that candle there. So, as far as the markets feel a lot cleaner and a little bit easier to trade. Things just feel a little bit different than they did the last couple of weeks. And if we look at the VIX, we see a big drop and down in the mid-teens once again. So we would likely expect this to continue for the next couple of weeks up until the Fed meeting here in the beginning of November. So we've got about 2 weeks from Wednesday is when the Fed meeting announcement is. The meeting will be Tuesday and Wednesday, and so Thursday we'll typically see a bigger reaction. So on the 4th, I'd be looking for fireworks. That means coming into this Fed meeting announcement, I will want to be putting on a hedge because if the market continues up, it's a good time to buy cheap insurance. That's basically what you're doing. So what I like to do, I typically use the SPY. You can also use the Qs. But if we are, so let's say we're today we close 447.19. If I wanted to put a hedge on today, I would look to buy somewhere around the 447 puts, so at the money. If I come over to the trade tab here and we go to the time is the first piece of the puzzle, like the expiration week or month. So if we think that next 2 weeks might be pretty much the same, but then we have this Fed meeting announcement, and so the Friday after that, we should see some resolve by that point. So November 5th, we could come in here to the November 5th weekly and buy the 447s. If you wanted to save a little bit of money, you could drop down a couple bucks and buy like the 443s at 340, so you save like $1.20. And so the couple of things that I like to look at. I try to buy as close to at the money as I can. I like the delta to be around 50, which is typically your at the money price. And then the theta, the time decay, is below 20 is super cheap per day. The delta is essentially how much the option will move when the underlying price, so the SPY, moves a buck. Now, the great thing about buying puts is that when the market goes down, volatility tends to go up, and so the option prices get inflated by that volatility. So I'm typically buying these puts at the close of the day when the market is up. So let's say we come up and we're making 3 or 4 days where we're gapping up at highs and things appear to be a little bit overextended, or we're coming up and we're at a double top, or we're at a like here at the halfway back short. That was a good opportunity on the 7th. Looking to buy puts when the market is up is giving you a cheaper entry. So you're paying a lot less than trying to chase it when it's going down. So let's say you did the like the 443s on November 5th, and you bought those for 340. I would say roughly, buying one contract for every 20 to 30,000. You kind of have to play with that number a little bit. Like if your long position is 200,000, you might want to buy 4 or 5 puts. You also could buy 8 or 10 depending on how much you think the market's going to move. But what I end up doing is, let's say I bought the puts. Let's say I bought them 2 days ago on Friday, the 14th. And then we came up and we closed above the 61.8 the very next day. I would just close them out. So I'm not going to wait till expiration and just let them go against me and hope that they come back. I'll just close them out for a small loss and then move on. So even if you bought, 10 or 20 puts and you only had a $100,000 long position, you're not necessarily risking the entire amount. But it's nice that you can, come in here and say, okay, well, if I'm buying a 341 or the 443s for 341, that's essentially my max loss. So that's kind of the approach in a nutshell, just as a way to hedge if the market goes down. And when the market goes down, it typically goes down really, really fast compared to when it goes up. And it's a great way to just, lock in some short-term gains as a swing trade. Even if you don't have like the Vanguard ETF is more of a growth fund. If you just have like, let's say you just own a bunch of Tesla, and you think, the general market is feeling a bit weak, and you want to buy some puts, it's a good way to hedge that long position without having to close it out entirely and then get back in. So, tomorrow morning we'll be doing a live trading session over at EminiMind.com/VIP. It's mostly focused on like ES intraday trading, but you can tune in there if you have questions or want to follow along with my intraday trades. And occasionally I'll talk about some swing trades as well. And I hope everyone has a great week, and I'll talk to you all soon.